So you talk about how there are a lot of great companies all over around the world that you can invest in. But for some people living in countries outside the U.S., it's actually not so great to be an investor. So they have these great companies, but just out of reach.
That's right. I mean, I think if there's something I've learned in my 3 years of being involved in the Motley Fool's international efforts, it's that we have it pretty good here in the U.S. And we probably take these things for granted. And there's certainly a lot wrong with the way that the investment industry works in the U.S. and the financial markets work in the U.S. But I think it's a pretty good structure and system overall. And I'll share a few reasons why. The first big one is fees. Morningstar does a report called the Global Investor Experience. It's issued every few years. In the 2013 report, of the 26 or 30 countries that they studied, the U.S. was the only country in the entire world that was given a letter grade rating of an A. And that was an overall letter grade rating. If just to use a very stark example, the fee structure in the U.S. for an equity mutual fund, the average expense ratio for an equity mutual fund here in the U.S. is 0.82%. So that ain't bad, and certainly has been driven down by ETFs and the likes of Vanguard and the rise of index funds. In Canada, our neighbor to the north, the average expense ratio in Canada is 2.42% for an equity mutual fund. You're paying just about 3 times more for a mutual fund, a stock-based mutual fund in Canada, which is outrageous in my opinion.
As a U.S. investor, you would have to search high and low to find a U.S. fund that charges that much.
You would have to really try.
Yeah, you would have to have an expensive fund being sold by a high-priced broker.
Exactly.
To be paying that much.
Vanguard in the U.S. is, they captured 20% of all fund inflows last year. They're now overseeing $4.1 trillion globally. Only 8% of that is outside of the U.S. though. So they have 3.8 trillion U.S. assets, and then they have 328 billion in the rest of the world. And now that's not for lack of trying. They have 13 offices outside of the U.S. I mean, they're trying to get a foothold. They're a fairly minor player in Canada, for example. And I think that the rise of Vanguard has helped bring down that for U.S. investors. It hasn't really done the same for mutual fund investors in the rest of the world.
And of course, Vanguard, bro, remind us what's so special about Vanguard and what they do.
Vanguard is a company that is very focused on fees, partially due to their structure. Like technically, the company is owned by the people who own the shares of the funds. So they don't have the same sort of structure that they're like a publicly traded company and they're trying to make profits for their shareholders. So they relentlessly focus on costs, and they are also the folks who brought the index fund to the mass market. And index funds just follow a common index like the S&P 500, but because they don't have to pay a manager and analysts, they can keep fees very, very low. And since you mentioned Vanguard or Morningstar, many of their studies indicated the best predictor of future success for a mutual fund are the fees. So if you're paying higher fees, you are much more likely to underperform the market and not get a good result.
It's not just mutual funds. In Singapore, for example, it costs a lot more to just buy a stock through a discount brokerage than it does in the U.S. It's not always priced per trade like it is here. Like TD Ameritrade is $9.99 a trade, or Fidelity is $7.99 or whatever. In Singapore, it often is a percentage of the value of the trade, but it ends up being often 2 times what you would pay to buy or sell a stock here in the U.S. And I have that according to our full Singapore team, which has written quite a bit about this issue.
Wow. So just to buy, just for even an individual investor to buy a stock, they're going to give up.
It could eat up as much as about $20. Yeah.
Wow.
And so, we've taken for granted that fees in general have come down as more people have gotten invested and more innovation has come through products like index funds, which spawned exchange-traded funds, ETFs, and things like robo-advisors. The U.S. Is at the, I'm going to regret saying this, but at the vanguard of financial innovation with things like robo-advisors, which have brought down fees and put pressure on regular financial advisors. So just across the board, the fee structure in the U.S. is typically more advantageous than you see in other countries around the world.